Okay, good afternoon. We are here for the Digital Finance Seminar Series, and it's our pleasure here to have today Pete Kyle, who is Chair Professor of Finance at the University of Maryland Robert Smith School of Business. I could give a long introduction, but I will be very short. Pete is, I think he's a legend in the area of market microstructure. He's one of the he wrote basically the foundational paper in the field, continuous auction and insider trading. This paper has inspired a lot of follow-up work. So everybody who is working on market microstructure, especially looking at information asymmetry models, they always go back to his paper. Of course, Larry also is another legend who is here. And he has done many other contributions, like most recently worked on market microstructure variance, and now today he's presenting about flow trading. And just briefly before being at Duke, he got his PhD in economics at the University of Chicago, and then he was a professor at Princeton and Berkeley before moving to Duke. And without further say, I would like to leave the floor to Pete.
Okay, well, thank you very much. Of course, now I'm at the University of Maryland, and we've got this paper with 5 authors on it. 4 of whom actually are affiliated with the University of Maryland. Peter Crampton used to be in the economics department at the University of Maryland, and he retired recently from Maryland. Zhongmin Li, Mina Li, is a PhD student in finance from the University of Maryland. It says WashU St. Louis. I forgot to change her affiliation. She's now at the Fed and Board of Governors in Washington as of a month or so ago. And David Malik is connected with the economics department at the University of Maryland, where I am right now as well. So this paper is called Flow Trading, but maybe it should be called something like Flow Trading in Portfolios. And I'll explain why as we go along. So, by the way, ask questions if any come to mind. I like answering questions. But if you look at the way trading in stocks and in general in financial assets works today, you see traders submit orders that are limit orders, and the limit orders have a price and a quantity and then a buy-sell indicator. You buy 100 shares of Apple at $150 a share or better. They're typically for individual assets rather than portfolios. And the way markets work is what's often called a continuous limit order market, which means that the orders are processed in continuous time. But in practice, that means they're processed one at a time. Every time a new order comes in, it'll either get executed or get added to the limit order book, and then the next event might be a cancellation, and that will happen, and they happens one order at a time. And the way markets work is affected very profoundly by discreteness. You've got discreteness in prices, that's minimum tick size. You've got discreteness in lot size, that's a minimum lot size. You can have different minimum lot sizes for trading and for quoting, but this discreteness is very important. And you might even ask, from the perspective of the 21st century, why do we have this discreteness? And I think the answer originally may be historical, that people used to do trades with pencil and paper, and you don't want to do 500 trades a second at prices that have like 10 decimal points in them if you're doing it with pencil and paper. You need to keep it simple, and discreteness was a way of keeping things simple. But discreteness also, I think, tends to maintain some market imbalances or allows market power to be exploited by market makers or dealers in various markets. At any rate, the current market design actually makes it costly for traders to implement certain types of trading strategies. If you place a standard limit order and it's just sitting there in the market, it might get picked off by a high-frequency trader, for example. It's also the case that if the tick size is really large, there may be multiple quantities to buy at the bid and sell at the best offer. This creates a problem of deciding which order gets executed when an executable order comes in to buy at that offer price or sell at the bid. And that typically is resolved with something called time priority, that whoever was in there first, was first in line, gets executed first. But that encourages a race, a speed race to be the first in the queue so that you have time priority over everyone else. That's costly for the people who are slower. even though it rewards the people who are faster. And if you're an institutional trader, the way that you likely trade is with something that maybe we call it a VWAP order, where you're taking a big purchase or sale and spreading it out over time and implementing it as many small orders executed over time. So you need to have quite a bit of bandwidth and quite a bit of capacity to handle lots of different orders in order to operate efficiently in today's markets. If you think about how arbitrage is conducted, if you think about how electronic markets work, that's especially kind of inefficient in the sense that as prices change, I may want to buy the undervalued asset and sell the overvalued asset, but the prices of both of these assets are moving up and down to some extent together. And so if both of them move up, I have to cancel whatever orders I had to do a long-short arbitrage of buying one and selling the other and revise the prices on both. And as the prices fluctuate, I wind up placing and canceling many orders. In today's market design, that eats up a lot of bandwidth and is fairly costly. So what we're doing in this paper, we call it flow trading, but maybe portfolio trading is a better idea. We're trying to combine three ideas. None of these three ideas is like profound in any sense, but combining them together, I think, gives us something interesting. So first of all, we have what we call flow orders, but flow orders have kind of two components to them. First is that rather than a traditional order, which looks like a step function, I think you're all on the same wavelength with me when you understand what I'm talking about. You submit an order that's a downward sloping demand schedule that's continuous, and we require it to be piecewise continuous. And without loss of generality, we can think of an order as a piecewise continuous function that executes a quantity of 0 at one knot point, and then at some other knot point executes a different quantity at a different price. It only has the one downward sloping interval, with 2 knot points on either side. And so that is that's going to require prices be continuous and also require that quantities be continuous. So unlike in the current market design where prices and quantities have this discreteness, we're going to get rid of that and make them continuous. And second of all, we're going to allow the orders to be executed continuously, more or less, through time. In today's presentation, we're going to think of time as passing in seconds. So continuous means in 1 second intervals. And we're going to allow traders who place an order to buy, say, 1,000 shares, not to show the 1,000 shares of size immediately, but rather, as it were, to execute 1,000 one-share orders consecutively over 1,000 seconds. That would be a way that we think approximates the equilibrium trading that traders would like to implement and that they currently approximate by shredding orders into tiny pieces. All right, that's the first idea. The second idea is frequent batch auctions. So what does that mean? That means rather than processing one order at a time, you let orders accumulate, and then you process a batch of orders at some predetermined time. And for just the sake of discussion, we're going to have the batching interval be 1 second. So every second there will be an auction. The auction will result in a market clearing price and a market clearing quantity. The market clearing quantity and price can be published. And you might say, well, isn't that a lot of information? And the answer is it's about 20,000 prices and quantities per day. That's a lot more information than you have in a lot of illiquid stocks, but it's a lot of less information than you have in a stock like Apple, which might trade, hundreds of thousands of times per day. And the third ingredient that we're talking about that's kind of new to this paper and is the main focus of this paper is that orders are going to be for portfolios. So we define a portfolio similar to the way they're defined in finance as a linear combination of assets. And we're going to allow positive and negative weights. So the S&P 500 would be a portfolio with 500 positive weights if you want to buy the S&P 500, with 500 negative weights if you want to sell the S&P 500. If you want to just buy one stock, that would be essentially represented by a sparse vector where one element is one share of that stock and then all the others are 0. If you want to do a pairs trade, buying one stock and selling another, there'll be one stock that has a positive weight, another stock that has a negative weight, and you would be buying that portfolio. We think of, by the way, selling a portfolio or selling shares as being buying a portfolio with a negative weight on those shares. So that's mathematically a convenient way to do it, and it's also kind of the way general equilibrium theory and economics thinks about these things. So we've got these three ideas that I just talked about that are different from the way the current market design works. Yes?
The first two ideas, you're trying to basically go from a discrete trading, discrete time to a continuous trading, continuous time. So
The
it's
way-
going from the old
Yes.
trading idea, I mean, to the electronic market making that we have today.
The way Eric Budish likes to say it, the current market design has discrete quantities, discrete prices, and continuous time. And we're going to go to continuous quantities, continuous prices, and discrete time. So we're going to flip around all three. Yeah.
Practically, in terms of implementing the first and last even, I don't know how you make time really truly continuous, because if you do 1 second at a time, isn't it kind of already discrete?
Yes. So we're making time discrete. Like in the current markets.
But if you fix the rate, given a time, you're dealing with like discrete quantity as well. So I'm kind of a bit,
Well, we won't be, because the question was, if we make time discrete by having an auction once per second, then yes, we're making the maximum quantity that you would buy if your order were fully executable, maybe 1 share per second. So it's 1 share, and you're saying, isn't the 1 share a discrete quantity? The answer, yes, it is. But if the price falls a bit and the equilibrium price is lower, the quantity you might execute might be 1/10 of a share, or it might be 100th of a share. It might be 0, because we have.
Second idea that makes really, makes sort of sets these two ideas. I mean, the difference of the two ideas. I mean, make a difference for these two ideas as well, right? With the batch option idea essentially.
Yeah.
Now that it's kind of similar to, in a sense, I mean, practically, because you have to work the discrete time anyway.
Practically, the current system might have a little bit of discrete time in it, but what we say continuous time, we mean processing orders 1 order at a time whenever they arrive. And they are arriving in continuous time. Okay, so we've got a list of benefits here. Number 1, investors can directly express lots of different preferences. They can, a lot of traders use VWAP, volume weighted average price. What this allows you to do is implement directly a close cousin, TWAP. If you place an order that is going to execute because you put a limit price on it, let's say to buy it as a real high price, so with high probability, the order is going to be fully executable, you would buy 1 share per second, for however many seconds you want, maybe thousands of seconds, maybe the whole day. And you would buy at a gradual rate, getting a price that's the sort of average of all those prices over the day. You can define your own portfolios. So you would, in some sense, you wouldn't have to use an ETF to conveniently trade a portfolio of stocks. You could define your own portfolio if you're an authorized participant to arbitrage the ETF, or you could define your own portfolio that's slightly different from the ETF, or you could trade an ETF if the ETF offers something that you're willing to pay for, such as managing additions and subtractions to the portfolio. You can do pairs trades. You want to arbitrage Google against Microsoft. You think they should be trading at a certain ratio. You can place an order to implement that ratio. In the current market environment, you would have to place and cancel thousands of orders to do a lot of these things. Secondly, we reduce the importance of speed, because we reduced the risk of resting orders being picked off, and also don't have this queue to race to place new orders at the bid or the offer, or to cancel existing orders at the bid or the offer when they're stale. It makes it very easy to do various types of arbitrage. I remember the old days when traders would arbitrage the Ginnie Mae futures contract that was mortgage-backed securities against the Treasury bond futures contracts at the Chicago Board of Trade, and it was human beings did that by running back and forth between 2 pits that were side by side. That was pretty inefficient way to do it. Here, you just place 1 order and sit back and let it execute. This allows, in Budish and Crampton Shim's paper, they like to talk about how when you get to very, very short time frames, the correlation that you're supposed to see or expect to see in asset returns breaks down, goes to zero. Here, it's not going to break down. The correlation is going to be hardwired by these arbitrage orders so that you get potentially the right correlation at all times. And finally, this proposal, or this way of organizing the market, has a kind of some transparency and fairness properties. Every trade that takes place at a given batch auction gets executed at the same price. And all the orders that could potentially be executed get executed. That's partly due to the batch auctions, partly due to the continuous schedules that you're required to submit at the batch auctions. In the current market, of course, traders, there might be a trade at the bid, but if there are a lot of traders, a lot of quantity at the bid, some will be executed and some will not be executed, and the ones that didn't get executed who complain that the market is rigged against them. And indeed, a lot of the complaints about market being rigged against traders is due exactly to this. Furthermore, we're going to be revealing information, the prices and quantities of each auction. It's a kind of limited, reasonable amount of information that everybody can get at the same time, so there's a certain amount of transparency there. Caveat is that we're not trying to correct market failures here. We're trying to implement trading, whatever the equilibrium, underlying economic equilibrium is, we're trying to implement it in a less costly manner operationally than the way it's traditionally implemented. Okay, so what we're doing is combining a bunch of fairly simplistic ideas that seem kind of obvious, but hopefully it's like combining them, the ingredients in a different way that they haven't been combined before to get something that's practically useful and interesting. We're combining the piecewise linear downward sloping demand schedules with portfolios as linear combinations of assets with the flavor of general equilibrium theory from economics. Haven't talked about it yet, but I'll talk about it some more. There's going to be a quadratic programming application, some batch auctions, and then some economic logic for why traders reduce, or at least implement the idea that traders want to reduce temporary price impact by spreading their trading out over time and trading slowly. This has got a technical, some technical stuff that it deals with. It's a quadratic programming problem where the existence and uniqueness is kind of well known, but useful for our purposes. And then the question is going to be, can you solve this quadratic program efficiently and accurately in less than a second so that you can have an auction every second for some fairly large number of assets, like 500 or 1,000 assets with maybe 100,000 or 1 million orders for all these assets that need to be dealt with in this problem. So can you solve that math problem fast enough? Okay, there's some literature here, but let me pause. Does anybody have any questions so far? Yes?
So is there a notion of social welfare in this?
The question is there a notion of social welfare
Is
here?
there a notion of welfare? So like how does this mechanism, how does this design reduce inefficiency? Is there a discussion about efficiency or?
Okay, so the question is about social welfare and economic inefficiency. I could give a very long answer, so I'll try to give a short answer. We're not trying to solve problems with adverse selection or other kinds of market failures associated with, say, market power. We're just going to take it as known that traders, due to market power, are going to restrict the quantity they trade or trade more slowly. And similarly, we're going to just take it as given that there's adverse selection. So we're not solving that problem. What we're doing is we're implementing something that's kind of the underlying equilibrium that markets implement today, but we think we're going to be doing it more cheaply. So it would show up as the kind of bid-ask spread cost, if you will, of trading an asset as being very small. The market impact costs are due to the underlying adverse selection and the underlying economics. They're going to still be there. So big traders will have big market impact when they trade big quantities. But little traders that trade little quantities should have much less of a trading cost than they would have otherwise. And even the big traders will have a smaller kind of bid-ask spread component to their trading costs. So that's kind of what we think of as the economic efficiency. But inside the quadratic program, there's a kind of, I like to call it a fake concept of welfare, where we're going to create a kind of welfare problem that's a sort of fake welfare problem, but nevertheless one that makes the problem easily solved by setting it up as a quadratic program that's a kind of a convex problem that therefore we could think we can solve fairly readily. Yes, another question.
I also have a question. So this kind of new kind of trading method, would it make banks that underwrite share pledges be easier to do those underwritings?
Would it make it easier for someone with a share budget to do underwriting?
Share pledges.
Share pledges, and like in the context of what?
Like borrowing money for shares. Yeah.
Okay, so I want to borrow money and I want to buy some shares?
Actually, I already like an individual already have some shares, but the individual wants to go to the bank and get cash in exchange to get it cash back by the shares.
Okay, so we're talking about how does this relate to the borrowing and pledgeability of collateral, I think is your question. And my answer to that is a little bit orthogonal to the paper, but built into the paper is the idea of trading portfolios. And if you could easily imagine an exchange that has a spot market for an asset and a forward market for an asset and a repo market for the asset that allows you to kind of finance the collateral, and they all integrated together. And essentially, they're arbitrage relationships that these things I just described should respect. And what flow trading would allow you to do is if you integrated the market for collateral with the forward and the spot market, you could enforce the arbitrage relationships in a very efficient and easy manner that would make it trivial for a retail investor to lend their shares and actually get paid a reasonable fee for the lending of their shares because the market's organized so efficiently they can actually do it. Now I think it's a little bit cumbersome and it depends on the way the brokers work. There's a literature that is in various different branches of economics and finance and computer science and mathematics. But I wanted to mention the perspective of our papers that I've worked on. I have a paper with Mina Lee that also proposes frequent batch auctions kind of in the same vein as Bootish, Crampton, and Shim. But their paper kind of justifies infrequent batch auctions, and we're trying to justify very frequent batch auctions. So we suggest having auctions for single assets occurring every millisecond, but emphasize the infinite divisibility of prices and quantities as being important. Bootish, Crampton, and Shim have their version of it as well. So that's where frequent batch auctions come from. But I also wanted to mention the second bullet point here, that there are theoretical models in economics that kind of justify the idea of trading in flows of assets rather than trading a kind of stock of assets at once. So started out with a paper by Vianos in '99, and then Du and Zhu have a paper, and I have a paper with Anna Obajayeva and Yajun Wang about this. And in our paper, traders endogenously choose to trade gradually over time. And they do that in order to minimize or reduce, maybe not minimize, but to reduce market impact costs. And it's a rational way to minimize market impact costs. And they do it with an alpha model. So they first calculate a kind of alpha for the assets, and then they have a target portfolio in which they want to buy or hold positive quantities of the assets that have a positive alpha, and they want to short the ones with a negative alpha, and they gradually trade towards a target inventory at an endogenously determined rate that depends on how fast other people are going to learn the private information that they have. So this model mimics extremely closely, we think, the thinking and trading of asset managers in today's stock market. And what our paper today does, the flow trading paper I'm talking about, it implements something that looks like this, except it implements it for portfolios. Our paper was for paper about one asset, market for one asset. This, of course, when you trade portfolios, like most asset managers do, you're trading them over time as well. And so this talks about how you would implement that kind of trading. Okay, so let me get down to the nitty-gritty of actually how the orders are going to work. Yeah.
When you mention that as the time gets shorter and shorter, then you still have some positive or negative correlation. It doesn't become zero. And the reason is that you have a portfolio of assets. If you had a single asset, that wouldn't be true, right?
That's right. So let me just repeat what you said. You said when time becomes shorter and shorter and shorter, Budish, Crampton, and Shem emphasize that empirically the correlation becomes lower and lower. And we're making that correlation hardwired not to go to zero because we're conducting a batch auction for portfolios that will clear at a certain point in time. So if I do a long-short trade to buy Google and sell IBM, that long-short trade will enforce a kind of positive correlation between Google and IBM. And similarly, if I do an arbitrage against, let's say, the SPY ETF that mimics the S&P 500, it will force a correlation between the spot prices of the S&P 500 and the SPY, which respects that arbitrage relationship. Whereas if you got down to microseconds in regular markets, it would maybe be going essentially to zero. Okay, so we're doing it by design. Yeah.
There's a question as to whether this is a market design innovation as opposed to product design or trading strategy design. I mean, because if you have these other elements in place, including the first and the batch auction, maybe it's up to somebody to design product that implements the different rates of the portfolio trading. Yeah.
I think so. I mean, I think in some sense this is like a product design that participants in the market could consider implementing. Because your question is this a product design or a market design?
Yeah, so market design seems hard in general.
Because it's mechanism design. Yeah.
But
So
product design is something that one can do unilaterally, right?
right. And so you're saying that market design is something that's hard. And I think it's hard because it's mechanism design, and mechanism design is hard. And we're certainly not trying to design an optimal trading mechanism. We're just putting an idea out there. There's one particular kind of mechanism simplistically described, and you can call it a product if you want. But it's one example of how trading might take place. Okay, so with all this background, let me, any more questions? Let me speed up a little bit and kind of skip through some mathematics where it's conceptually pretty clear, I think. So we're going to trade portfolios. So when you place an order, you're placing an order to buy or sell a portfolio. You need a description of the portfolio as part of your order. The description of the portfolio is a vector we call W of portfolio weights that describe the portfolio you're trading. Okay, so if there are 1,000 assets, it's 1,000 by 1 vector. If you're trading the S&P 500, half of those are zero and half of them are non-zero. You need to specify an upper and a lower limit price for this portfolio. The upper limit price is the price at which, for any higher price, you would buy zero, and you'd buy zero at that price as well. The lower limit price is the price at which you would buy the full quantity that your order wants to buy. Okay, and then in between, you prorate the quantities linearly based on the price of the portfolio. Then QI here, lowercase qi, think of it as the rate. It's the number of shares that you would buy at one auction that would, keeping in mind they're occurring every second. So we like to think of that as being something like one share if you're trying to buy shares of stock. And then there's Q max, capital Q, which is the total number of shares that you want to buy. It might be 10,000 shares. And if you placed an order with a high enough limit prices to buy, you would then buy your 1,000 shares, one share at a time, over 10,000 seconds, about 3 hours. So that'd be a patiently executed order to gradually execute in order to buy 10,000 shares. Now I'll repeat what I said earlier, that if you want to sell a stock, the portfolio weight W is just negative, but you're still buying the portfolio. And if it's a pairs trade, one weight's positive and one weight's negative, you're buying the portfolio. Okay, so these two limit prices, we call them PH and PL. You might ask the question, how does this way of thinking about an order relate to the standard orders that we see in the markets today? And the answer is, in the markets today, it's kind of a limit where PH and PL go to the same quantity, and the little q and the big Q become the same. And W would typically just be one individual asset. So this is a generalization of what we have today. Any questions about this part of it? Okay, so I already said that when the price is at or above pH, you buy the entire little lowercase q, the entire quantity in your limit order. When it's below PL, the lower limit price, you don't buy. Excuse me, I said it backwards. When above pH, you don't buy anything. When it's below PL, you're fully executing the order, and in between, you're linearly interpolating. So we can write all this mathematically. So I'm going to go do a little math now, but I can flip through the slides because I think the intuition for the math is pretty obvious. The way to understand the math is to keep two things in mind. We've got prices for assets and prices for portfolios. The demand schedules for the portfolios are functions of the prices of the portfolios. But we want to clear the market for assets, not the market for portfolios per se. If I want to buy the S&P 500, I don't have to find someone who wants to sell the S&P 500. I could buy the S&P 500 by buying little bits, individual shares from 500 different orders in the appropriate weights. When my order to buy the S&P 500 is partially executed, I will buy exactly the same proportion of each of the shares that will respect the portfolio weight. So if I'm half executed, that means I'll buy exactly half of the portfolio weight in some sense, number of shares for each asset in the S&P 500. Okay, so P, the letter P is going to represent the price of the portfolio. Pi is it's going to be Lagrange multipliers eventually, but right now it's just market prices for the assets. So there may be 1 million orders, so there are 1 million Ps, but there may be 1,000 Pi's because there are only going to be, let's say, 1,000 stocks in our market. And so the price of the portfolio is just the inner product of the portfolio weights W and the prices of the assets pi. So it's pi transpose W. You can write down some mathematics for what a piecewise linear demand schedule looks like, but it looks like what you're seeing here in these pictures, and I don't think I have to describe it too much. But there is a little bit of arithmetic with negative numbers that you have to respect, that the prices of a portfolio to sell at $42 a share, the price is going to be actually minus $42 because it's the cash flow that it takes to execute that trade. So what do we have here? We've got a flexible, but we say limited language for traders to express a way of trading, kind of you could call it preference expression, but I don't think of it as like they're expressing their utility functions in some honest sense. They're just telling the market what kind of trade they want to execute. And it's fairly flexible because it allows substitutes and complements in some sense. It allows urgency to be expressed by having a lowercase q being different from the big Q, that the rate at which you buy can be different from the total quantity you want to buy, which means the time horizon can be very long or very short. And you can approximate a pretty arbitrary continuous downward sloping demand schedule for portfolios as a function of the price of the portfolio itself with piecewise linear functions just by adding together lots of different piecewise linear functions. Let me just keep going. There's some limitations here. These demand schedules we require to be downward sloping. That's going to create a convex problem for us later on, which that's an intent to make things easy in that sense. Your trading demands have to respect exactly your portfolio weights. Your trading demands are linear within each order, although I said you could approximate something that's nonlinear. We don't have indivisibilities. The demand for the portfolio depends only on the portfolio price. This is kind of consistent with the way demands for individual assets work in today's markets. You submit a limit order to buy Google. It's a function of the price of Google. It's not a function of the price of Amazon. That means that you can't have these kind of orders that are related to other types of contingencies. Okay, so what do we have now? We have an idea out there of allow traders to trade arbitrary portfolios that are linear combinations of assets. And calculating market clearing prices now suddenly seems to be not so trivial. You know, if it's demands for an individual asset, you can add up all the individual demand schedules and get a kind of aggregate demand schedule that's downward sloping for the assets that you want to that are in the asset that's traded in the market, and then you can just use Walrasian tâtonnement or bisection or something to easily find the market clearing price. But when you're trying to clear the market for 1,000 assets simultaneously when there are portfolio orders, it becomes quite complicated. If I submit an order maybe we start with some market clearing prices, but I submit a non-trivial order to buy the S&P 500. Well, 500 prices are going to obviously change, and probably all 1,000 prices are going to change. But suppose I submit an order to just buy one share of Google. Well, potentially the price of all 1,000 assets in the market is going to change, because there may be portfolio orders connecting all of the assets together. So in order to calculate market clearing prices, you'll have to solve 1,000 equations and 1,000 unknowns if there are 1,000 assets. And so how can you solve the 1,000 equations and 1,000 unknowns in 1 second? Well, let's first describe what the equations are. So for any conjectured price vector for assets, pi, we can calculate a market demand schedule that's a function of that vector of prices, pi, by summing up the demand schedules implied by all of the orders that the traders have submitted. And those orders are have the vectors of portfolio weights, W, in them, and then DI represents, capital DI here in this notation. In the equation, you see equation 3 represents the piecewise linear schedule for that particular portfolio. And so what is the exchange doing? And keep in mind the pi transpose W that you see inside of D, that's the price of the portfolio expressed in terms of the prices of the assets, pi. So what the exchange is trying to do in equation 4 is take the aggregate demand schedule and find a vector of prices that clears the market for all 1,000 assets simultaneously. So I'm going to keep using the example of 1,000,000 orders and 1,000 assets. And then if you can calculate those prices, then you can calculate the price for each portfolio, pi transpose W, and then you can calculate the quantity demanded by each order, the demand function for that in equation 5, and call that the quantity X that's traded on that particular order. So X will be somewhere between 0 and little q. It'll be some fraction between 0 and 100% of the total number of units you wanted to buy. So any questions about this market clearing problem? Yes?
Yes, that we have a unique solution to this.
I'm going to talk about that. Okay, so I'm going to skip this one. So there's your question. The question is there a unique solution? And I'm going to skip all these slides because it's pretty well known. But the answer is going to be that we're going to address the existence and uniqueness problem by turning this into a quadratic program. And the way we're going to do that is, even though the traders haven't really expressed preferences, they've just implemented a strategy, we're going to pretend like they're expressing preferences. And what do those preferences look like? The preferences look like a quadratic utility function where X is between 0 and Q. In other words, if the order is partially executable, it's quadratic because the demand schedule is downward sloping and linear. And then outside of that, it's linear because the demand schedule is, the quantities can't change. And so you've got a quadratic utility function with some linear pieces pasted on the side to make it in a way that makes it kind of continuous at the knot, what were the knot points in the demand function. So these quadratic functions kind of can be thought of as like utility functions.
For like utilitarian, maximization of utilitarian.
Yeah, so now we can pretend that we're a utilitarian and we're maximizing the greatest good for the greatest number by putting the same weight on all of the utility functions and add up all the utility functions.
So when you say utility function, you mean utility as a function of the allocation you get?
Yes. Yeah. So, and it's going to be expressed, here it is, equation 6. It's a quadratic function of X, which is between 0 and Q, and it's the number of portfolio units. You have a preference for portfolio units of the various portfolios in the 1,000,000 orders that you have. So for the ith order of those 1,000,000, it's quadratic given by equation 6 if X is between 0 and Q, and you can define it for X outside of 0 and Q as well. And then what you're maximizing is the sum of all these utility functions. So it's maximizing the sum over the X's, the number of units of the portfolios consumed, if you will, or executed for the 1,000,000 orders. And that's a quadratic objective essentially, because you're going to be confined to the quadratic region because X is going to have to be between 0 and Q. And it's going to be subject to two sets of constraints. One set of constraints says that market's clear. But that's not a million things clearing, it's just 1,000. 1,000 asset markets clear, so the sum of the X's multiplied by the weights on the orders for those X's has to be 0. And then you have some inequality constraints that say that the X, the number of portfolio units you execute, has to be strictly between, or not strictly, but between 0 and Q. And it can't be outside of that, so that's the inequality constraints in equation 7. Yeah.
Can you repeat the equation 6? I'm trying to understand the two terms. The first part is the expected return, right? The price times the quantity.
Yep.
Yeah, portfolio.
Okay, so the question is, how do you interpret question 6?
Yeah.
Equation 6.
The second term, like it should be some risk aversion times the variance, right?
You could think of so equation 6 is just a quadratic function. So it's got a linear piece, which is where pH times X, which is the margin, pH is the marginal value of the portfolio when you're right at the execution price where price is equal to pH. And then you have a quadratic term that says if you consume more than X, you've got diminishing marginal utility, and it's linear marginal utility, so it's quadratic utility.
I guess what you're saying, is that any order of the form that you allow can be rationalized as being an optimal solution to.
That's right. And the emphasis, any order of the form that we allow can be, and you said it, rationalized, as not rationally interpreted as, but rationalized as this utility function, even though the traders may be maximizing something entirely different.
But it's not linear demand. You are allowing for piecewise linear, right?
Yeah,
So
piecewise linear demands.
still can be done.
Yeah, so piecewise linear demands means that we not only have to respect the market clearing conditions in equation 7 there are 1,000 market clearing conditions, but we have to respect 2 million inequality constraints. One that a million of them say don't underfill the orders and a million of them say don't overfill the orders, right? So then the question is going to be, can we solve this problem? And also existence and uniqueness like you asked for a minute ago. So this is a quadratic optimization problem that's got in 1,000 linear equality constraints in force and market clearing, and it's got 2 million inequality constraints. So at the bottom of the slide, you can see it's just kind of written out in a somewhat, maybe not quite exactly the way that people in operations research would write it out, but approximately something they would recognize. You've got your maximizing the quadratic objective subject to inequality constraints. Capital W is all the vectors of all the portfolio weights stacked together. Matrix multiplied by X is equal to the 0 vector, 1,000 by 1 0 vector of assets. And the inequality constraints are also satisfied. But they're a million 0 less than X constraints and a million X less than equal to Q constraints. So existence and uniqueness, I'm not going to read through the theorem, but basically there exists a unique set of quantities that will maximize the objective function, but the prices don't quite have to be unique. It's pretty obvious that prices aren't going to be unique because suppose you just had one asset and you only had one order. The order might be a buy order to buy at a price of between 95 and 100. Well, obviously the quantity of trade is going to be 0. Now, obviously, any price that's 100 or higher is going to clear the market. So market clearing prices can't be unique. However, they do belong to a compact set. Okay? Now, the more important details for our quadratic programming problem are the feasibility of the kind of the problem. And X equals 0, that is no trade. It sits on the boundary of the feasible set, so it's not exactly making it feasible, but we're going to tweak the problem in a few minutes, and that's going to make it feasible. So the fact that no trade is a possible outcome is kind of going to solve our feasibility problem. Yeah.
So can you go back to the optimization problem on the prior slide?
Yeah.
So the constraints give you a market clearing and a limitation on the quantity amount, right? Could I think of having other objectives there aside from this one? Like, it seems like there would be many sets of allocations which would give you market clearing and so on. Is there something special about? I mean, I guess that objective is the only place that the pH and PL are enforced.
The quantities, the market clearing quantities X are unique.
Well, unique subject to that objective.
They're unique in the sense that if I announce some prices, and everybody then, if all the market participants, let's say, calculate how many units of their portfolio they're going to buy at those prices. I need to make everybody happy. And there's a unique set of X's that makes everybody happy.
Okay, and that's
So
gonna
there's a
come from
unique
the pool of
allocation
this.
so it has to be the same, whatever, the solution to the problem has to be some unique vector X, okay? Now, the prices just don't happen to be unique. So I would say this is the only way to kind of make this problem make sense.
Follow up on that. I mean, could you maybe vary the objective and the bidding language at the same time?
You could do
So you
that.
had an analog of this.
Yeah, you could vary the objective in the bidding language, or you could change the units, but they're going to be economically kind of equivalent, I think.
So,
Yeah.
so this the formulation of utilitarian welfare, use of utilitarian welfare is kind of arbitrary. You could have used different weights, right? And the solution should not be variant. It should be invariant to this. Because
I don't think you can use-
trying to find the market clearing.
I don't think you can use different weights. I think you have to have the social welfare function, if you will, that's in equation 7, the sum of the VIs, has to be the sum of the VIs. Now you could multiply it could be a linear transformation of that sum, but it can't be arbitrary weights on the VIs, because then you're going to get a different set of X's. You're going to maybe give more X to people that you like and less X to people that you don't like, and they're going to look and say, well, my order wasn't executed the way it was supposed to be given the prices that you're telling me.
Equal treatment of equal forces
Yeah.
you to have the same weight.
Yes, so the equal treatment, giving everybody the same prices and letting everybody's order be consistent with those prices requires equal weights. Yeah. Okay. So we've got existence of quantities that's pretty obvious here. So I think I'm gonna just kind of skip this slide. You've got a dual problem, and we go through and talk about the dual problem a bit. But mostly we're talking about the dual problem for a reason that winds up being irrelevant to the paper. So I'm gonna skip that one too. And so, but part of the dual analysis is not only do you get unique quantities, but you get market clearing prices exist, but they're not unique, but they're in a convex set that may or may not be compact. And then the next question is going to be computational. So we've got these unique quantities we're trying to calculate. We've got prices that might be unique but might not be. But can we calculate them in a, practically speaking, in a very short period of time, like less than a second, because we want to have an auction every second. And the short answer to the problem is the way a lot of economists think about it, they would use a gradient method, because the gradient method is closely connected with Valrégion and Tâtonnement. It's about this, essentially, I think it's the same thing. But the gradient method doesn't work very well in a problem like this with 1,000 assets if the demand functions are kind of weird. It'll be very, very slow to converge. And furthermore, the gradient method, in a finance problem like this, we want to calculate the prices and quantities reasonably accurately. But a problem with the gradient method is that as it gets closer to the equilibrium, it converges more slowly, so it never really becomes that accurate. So instead of using the gradient method, we're going to wind up using an interior point method. The gains function here is largely relevant for the gradient method, so I'm going to skip through all of this. And we're going to use an interior point method. And to use an interior point method, the idea, it's motivated by a logarithmic penalty function. But the idea of it is that you start with an interior point that respects the inequality constraints by being on the interior of the inequality constraints, but not at the boundaries. You need to have at least one interior point. It may not be the optimal one, but there needs to be a feasible, as market clearing interior point to start your problem off. You might think zero trade would be the good starting point, and the answer is it is a good starting point, but it's not an interior point, it's on the boundary of the set. So in order to address that problem, and also to address the problem of what happens when prices are not unique, we introduce the idea, it's more of a conceptual or more of a numerical technique, but the idea of thinking of the exchange as a market maker. So we let the exchange submit a tiny order, meaning a very, they're not going to trade large quantities, but a linear demand schedule for each of the 1,000 assets. So we add like 1,000 little demand schedules into the existing orders. unless the prices fluctuate by some huge amount, the exchange is not going to trade very much. But what that means is that if we take each of the existing orders and instead of execute a quantity of 0, let them execute a quantity of epsilon, where epsilon is some very small quantity, the exchange can pick up the balance. And this will be an interior point that shows that at least we can start our interior point method off with an interior point. Furthermore, well, let me keep going. So we add the exchange to this by, you can sort of give the exchange a kind of utility function and add the exchange's utility function to the other utility functions, and that gives you equation 18, which is a kind of modified objective function or modified quadratic program. And what the interior point method does is gives you these log penalty functions instead of the inequality constraints, which is equation 19 that you're looking at. And I have a discussion here of the complexity of the interior point method that I'm going to kind of skip over here, but it's not terrible complexity compared to other alternatives. And we know that the equilibrium to the problem is specified by these KKT conditions. These are the KK conditions for the problem itself. But with the interior point method, what you can do is you can replace the KKT conditions with some kind of modified conditions where the complementary slackness condition winds up saying not that your multipliers times the quantities are equal exactly to 0, but that instead they're equal to some constant that we're going to think of as being very small. And the idea behind the interior point method is you replace the KKT conditions with this with these modified complementary slackness conditions, which come out of the log penalty function, depending on how big the penalty is. They basically measure how big the penalty is. And that gives you a problem that has this form here that you're looking at in equations 24 through 27. And so what we've done is implemented an interior point method that solves these equations and then tries to do it, or does do it, for eta, this complementary slackness modified parameter, but make that parameter very, very small so that you're getting very, very close to the original problem. And you can then check that your proposed solution to the original problem actually clears the market and actually respects the demand functions. And it does. So what we did is we simulated it, and the way we simulated it is we need to construct an order book. So most of the complexity of this is not so much the algorithm as it's the construction of the order book. And we wanted to construct a book of orders that was in some sense realistic, but in some other sense was pathological. So what's realistic about it? What's realistic about it is a lot of the orders are to trade portfolios. So we define a market portfolio, we define value-weighted portfolios, which are really trading volume-weighted portfolios that are in, maybe 5 of them or 10 of them. We define industry portfolios, which are kind of an arbitrary slice of some random orders across these things. And we let the volume vary tremendously so that some stocks have really, really high trading volume and other stocks have really low trading volume, and the market portfolio has a huge amount of trading volume. So what does this do? It actually makes the problem very poorly conditioned. So there's some assets that may not have any orders at all. They show up in the portfolios, but they don't show up as orders for those individual assets. So the prices of those assets are very poorly defined. And then there are other assets that have huge numbers of orders, like the market portfolio itself, and portfolios that have huge number of orders. So we made it, it's kind of, it's pathological in the sense that we made a lot of the orders be very steep, in the sense that pH is close to PL. So that means that these downward sloping demand schedules are mimicking step functions that kind of it's almost like mimicking a linear program with a quadratic program. And that was designed to make it kind of stress the algorithm to make it harder to solve. So we use our base case scenario, 500 assets and 100,000 orders. But I wanted to just show you the results, and the results are in this picture, and then I'm going to stop. On the left-hand side, the number of assets is 500. And then we're looking at the computation time as a function of the number of orders. And for 1 million orders, we're still below a second, although not by much, on workstation as of a couple of years ago. And you can see that it kind of plateaus at 1/10 of a second, which is, I think, basically Python overhead, because we wrote this as a Python program. And then on the right-hand side, we keep the number of orders at 100,000 and let the number of assets increase from 10 to 10,000. And again, and here we find that with 1,000 assets, 1,000 orders, the number of orders, 1,000 assets, we're still under a second, but somewhere around 2,000 assets, we go up. And the slope that you're seeing here on the right of the second picture is going to be ultimately governed by a Cholesky decomposition that's part of the technique that we use to implement this interior point method. The interior point method is an iterative method where you kind of linearize those KKT equations. So it's like Newton's method in that sense, and then you pick a direction and you try to go in that direction, maintaining an interior point, so you may have to truncate back a little bit to maintain an interior point. But at each iteration, you've got to solve a linear system. That's this gigantic linear system. But the way we solve it is reduce it to an equation that's got the number of assets by the number of assets, 500 by 500 or 1,000 by 1,000. And use the Cholesky decomposition. And that works pretty well, but it doesn't work well when you get to 10,000 assets, because the Cholesky decomposition is an n-cubed algorithm. So every time you multiply the number of assets by a factor of 10, you multiply the computation time of that decomposition by a factor of 1,000. Anyway, we think these simulation results are kind of a proof of a concept, and we're still playing around with algorithms and still trying to improve on what we're doing. The exchange trading that we introduced it at a level so that the exchange participates in about $1 out of every 10 to the minus 7th dollars out of every dollar of trading volume. Out of every, the exchange share of volume is like $1 for every $10 million of trading volume. So this is $1 spread across 500 or 1,000 assets. So we think it's like economically trivial, and so ultimately this is just a numerical device for making sure that we can calculate the equilibrium. It also has the effect, when the equilibrium prices are not unique, of making the equilibrium prices kind of unique, and by making the problems strictly convex, or at least making that linear system that you have to solve at each iteration, making it a positive definite system and not just a positive semi-definite system. I've got a section in here on micro foundations for portfolio orders. I think I'm going to skip it because I'm out of time, I think, yes. And these additional issues, I think I'm going to skip and just conclude that we've introduced this new, what we think of as a new design for trading financial assets that has elements of papers that we've all worked on in the past. We've shown that you've got unique quantities and prices that are within a convex set that can be calculated by solving a quadratic program, and that solving it in less than a second is feasible for some reasonable number of assets and reasonable number of orders. And it's got the benefits that I talked about at the beginning of this talk. There's some topics for future research that we want to be careful about what the kind of cost-benefit analysis of this is, and we think that I think that the cost-benefit analysis is mostly that it's an efficient way operationally to operate a market, so that it ties up less resources and computers, bandwidth, mostly bandwidth, and what Bush-Crampton and Shim call the arms race for high-frequency traders to build faster microwave towers and things like that. And we think that it will make prices look more efficient by enforcing arbitrage conditions in a cleaner and more in a simpler way. So I'll just stop here, and if you have any questions, I could go back and talk about some of the things I skipped. Okay. Yeah.
So what do you think is the most practical, practical was the biggest obstacle to implementing this kind kind of thing? Is it batch auction? Is it
I think there are two obstacles. You said, what are the practical obstacles to implementing this?
the willingness on the part of the real market exchanges to
Yeah,
adopt something?
and I don't think there are any technological obstacles. I think there are two obstacles. One obstacle is regulation. So like, for example, SEC regulations require that an exchange, so if this is going to be implemented by an exchange, the exchange has to post bid and offer quantities in a manner that respects a tick size of a penny, and the sizes have to be like 100 shares. So there would need to be some kind of regulatory relief to allow this to operate in a nice, clean manner. And I think the other obstacle is that we would be reducing some costs that are costs borne by traders, but those costs are associated with rents earned by other traders. And the traders that earn those rents might oppose this for the same reason that floor traders opposed going to electronic markets, specialists opposed the introduction of electronic markets, and in general, technology and finance tends to get, new technology tends to get opposed when there are vested interests to oppose it.
But how open do you think the market may, exchanges are in adopting frequent batch auctions?
It's a good question. I think the exchanges should be open to this. For it to operate, the question is how open are the exchanges to this? I think the exchanges should be open to it. For it to operate most efficiently, you would need to have the exchange that's operating our portfolio auctions to actually have a really high market share, because frequent batch auctions essentially require that all the order flow be there on that exchange. And if you have, what we think would happen is that if one exchange implemented this and the other exchanges didn't, then we think the exchange that implemented the frequent batch auctions would actually survive and win in competition with the other exchanges. And the reason is that when prices are moving around, each exchange is submitting orders to pick off the other, or, orders are coming to pick off orders on exchanges based on what's happening on other exchanges. And our design means that when an order comes in to pick off an order on our exchange, with the frequent batch auctions, you don't get much of a rent from that at all because you're only trading a fraction of a share. But when something happens on the flow trading exchange that is relevant for the other exchanges will be picked off, and they will be picked off with much more severe consequences. So the result of that, we think, is that if you had a level playing field of competition between 10 exchanges and one of them was implementing the flow trading with the batch auctions, the one that's implementing the flow trading with the batch auctions would win. And similar to what you saw when electronic trading was introduced, there were people that thought, oh, the floor with human beings, that's absolutely necessary for efficient price formation. There's no way that electronic markets would compete. But the way it got implemented was the CME let them both trade side by side. And when they started making the fees more comparable, the electronic market started winning. Why did the electronic market win? It was because traders wanted to place electronic orders rather than trade through the floor traders. They could slice and dice the orders into smaller pieces and execute them more gradually in a much more efficient way. And they didn't have to trust the broker to represent their interests accurately and honestly in the trading process. And then finally, and I think this was the most important reason was that with manual trading, it was just a pain to check and execute orders because there were lots of errors and lots of costs associated with just doing the pencil and paper work to enter the manually executed trades into any kind of trading system. I know that sending an order to be executed by a human being kind of requires another human being sometimes, and that's costly because human beings aren't cheap. Any other questions? Okay, I don't think I see any questions. Yeah, thank you.
Thank you again, Pete.
Mhm.